He thought he was selling a single share. Instead, he nearly crashed Japan's financial system. On the morning of December 8, 2005, a trader at Mizuho Securities typed an order. It was supposed to sell one share of a company for 610,000 yen, but he did it backwards. He tried to sell 610,000 shares for 1 yen each. In less than a minute, the Tokyo Stock Exchange plunged into chaos. Billions vanished. The order couldn't be canceled, and no one, not even the exchange, could stop it. Today, you'll see how one typo shattered market logic and exposed a terrifying truth. Nobody is really in control. The phone lines were quiet, just the sound of keyboards and screens flickering across the Mizuho Securities trading floor. A routine morning, until one trader entered a sell order. One line of code typed under pressure. No double check, no alert. Just numbers. 610,000 shares of JCOM priced at 1 yen each. A simple mistake. But in the financial bloodstream of Tokyo, there is no such thing. The order was sent and accepted. No questions, no warning. The system didn't ask, "Are you sure?" It simply obeyed. Within seconds, that one command began draining the market. JCOM only had 14,000 shares in existence. The trader had just tried to sell more than 40 times the total supply for a price that was effectively zero. And yet, the Tokyo Stock Exchange's automated engine processed it like gospel. It matched orders, it cleared trades, it followed protocol. Billions in exposure ignited like dry leaves under a magnifying glass. Back at Mizuho, someone noticed. The price feed looked wrong, too low, too fast. Then the realization hit. They hadn't sold one share. They'd sold the whole company into vapor. Panic spread across desks. The cancel button was hit once, twice, again, and again, but nothing happened. The system didn't allow reversals of active trades already in motion. The machine had already decided. It was executing, and it wouldn't stop. They called the exchange, pleaded, shouted, demanded a kill switch. But there wasn't one, not for this. By the time anyone could act, it was too late. The market had digested the poison, and now it was tearing through the bloodstream of other stocks, other firms, other systems. And in the center of it all was a blinking screen, still processing a typo that should have been caught by a line of code or a moment of doubt. By mid-morning, Tokyo's exchange had frozen trading in JCOM. The damage was already staggering. Losses measured in billions, reputations evaporating by the hour. The trader was in shock. Executives scrambled to contain the fallout. But beneath the immediate crisis, something far more dangerous had just been exposed. Not a human mistake, a structural flaw. The kind of vulnerability that hides in silence, waiting for someone to trip over it again. And someone would. The screens were turning scarlet. Every trader in Tokyo felt it. Figures were collapsing in real time, red digits swallowing green. The ticker symbols tumbled like dominoes, dragging other stocks into the void. The mistake wasn't contained to JCOM anymore. It was metastasizing. Inside Mizuho's war room, voices clamored. Analysts pored over monitoring tools, fingers hovering over keyboards, hearts racing. The panic had a rhythm, a ticker update here, an alert tone there. In seconds, the trading floor became a silent symphony of dread. No one knew how far the impact would spread. The orders continued piling in. Outside the exchange's core, liquidity tanks were draining. High-frequency algorithms sensed pressure and retreated, adding to the pressure spike. Brokers shouted into phones, some into voicemail, some into the void. The rest of the market watched, paralyzed. Newswires in Tokyo buzzed at lightning pace. Flash, trading halt hit JCOM after erroneous sell order lit up screens. Within minutes, financial media exploded with analysis, speculation, blame. Was it a cyber attack? Technical shift glitch? No, just a human finger that slipped. But that slip nearly shook an entire exchange. The panic didn't wait for perception. It spread through derivatives, ETFs, mutual funds. Even firms with no direct exposure to JCOM saw red. For some, positions blew through risk thresholds and auto-sell triggers kicked in. The ripple effect became a wave. Orders that shouldn't have been triggered were triggered. Volatility spiked. Tokyo was suffocating under its own complexity. Back at Mizuho, senior management convened a crisis call. Phones rang across continents. London, Frankfurt, New York, everyone asked, "What about exposure?" The message was clear. It's not just here. In a globalized market, shocks travel faster than light. The trader waited in a small office, somewhere in Tokyo, cuffing and uncuffing his hands around his mouth. He was being treated as urgent focus, as living evidence of catastrophic failure. Yet he was just the point where everything erupted. When the screens finally blinked into a freeze, trading halted for JCOM, the air seemed to crack. It was like hitting the pause button on a nightmare. But the damage had already been done. Losses were tallied. Tens of billions of yen gone in moments. Lives upended. Trust broken. It wasn't just money, it was confidence. Yet panic isn't just a moment. It's the echo that follows. Regulators entered mobile chat groups. Tokyo Stock Exchange tweeted a vague apology. Brokers updated their pages. But nothing could replace hours of ruthless market logic that had already played out. Brokers in London and New York were seeing brief spikes in their systems tied back to Tokyo's train wreck. And then came the public outcry. Social media in Japan lit up with angry speculation. How could we let one error destroy billions? News anchors interviewed finance experts who shook their heads. We are only as strong as our weakest key. The phrase became a hashtag. That social pressure put a new kind of pressure on regulators and exchange operators alike. At Mizuho's headquarters, they prepared for regulatory inquiry. Panels were assembled, logs collected. Legal teams drafted statements. But beneath it all was fear. The mistake was human, but the consequences were institutional. They would need to show they had systems to detect and prevent such disasters. And more importantly, they'd need to show they had already begun to build them. But what came next didn't flash across screens. It happened in silence, in courtrooms, in negotiations, in shadows. And it would decide who would take the fall. In the hushed offices of Mizuho, a single voice cut through the tension. Not a trumpet, but a whisper. A junior analyst, eyes glued to the screen, noticed anomalies. Sell orders bursting at impossible speeds. Margin calls flooding like flash floods. She flagged it. Anomaly. 6 zeros too many. 1 yen trades flooding in. It could be a glitch. It could be sabotage. It could be a typo that would bankrupt them all. She tried the protocol. Alert managers. Double-check the logs. But the systems had no protocol for this. They had alerts for spikes, for shutdowns, for cyber attacks, but not for, please pause, human error. So she escalated. A few clicks, a message sent up the chain. Then the real risk began. Someone up there heard pause. Someone else heard system error or market panic. Mizuho's crisis team convened fast, came down like a judge. Phones off. No logs to the exchange yet. What if we create more panic? What if the news leaks? Who loses credibility? Who loses face? Who loses power? But the junior analyst persisted. She walked the floor, showed graphs that didn't make sense, demonstrated the spread of a trade that should never have been. She named the ticker. She named the price. A typo. That was all. But she became the voice that refused to be silenced. "We must alert the exchange now," she said. In the boardroom, someone used the L word, liability. "Are we sure? This could trigger regulatory storms." Around the table, the senior managers weighed reputations against responsibility. They chose to alert the exchange. Phones rang. One message to the trading surveillance unit: "We have a fat finger incident. Please intervene." Moments later, the exchange replied: "Order is already executed. Freeze initiated on JCOM." The whistle had blown, but only after the thunder struck. Publicly, Mizuho acted austere, statements carefully drafted. Legal teams sent feverishly revised reports. "We take responsibility. We will cooperate." But off-camera, they whispered among staff, shifting blame. Our system didn't stop it. Even as the junior analyst was rewarded discreetly, she was warned to stay silent. From the shadows, regulators dug in. They deposed her. They asked her to repeat every step she took. She recounted the logs, the chain of command, the minutes before the phone call. She spoke of fear, of hesitation, of the unknown hesitance that could have cost everything. Her name never made a headline, but her action shaped the outcome. On the public stage, the exchange cited unprecedented command execution. Mizuho took symbolic fines, paid millions, but no one admitted full culpability. The analyst watched in silence as her voice echoed through boardrooms and courtrooms, shaping reform. No one thanked her in public. She was the unseen fulcrum of justice. What the world saw as a technical glitch was, in reality, human courage meeting systemic opacity. And while markets bounced back, protocols changed, trading filters were installed, the underlying architecture remained untouched. Behind that moment of truth, the deeper flaw lingered: systems made to process, not to question. And as the strategist offices rewrote compliance manuals, the question persisted: would the next whistleblower speak up before or after the next collapse? The lights in Tokyo flickered as screens rebooted. Fewer red graphs now, but the scars remained. And beneath that veneer of recovery, the real culprit lurked: the system that let a typo turn into a meltdown. From code to compliance, infrastructure to incentive models, the engine roared but never hesitated. It started with design choices buried deep in trading architecture. Engineers built pipelines for speed, not scrutiny. No thresholds, no real-time sanity checks. Every order was an and, not an if. They trusted execution, not understanding. Traders moved faster than the systems ever intended. They relied on normalization, not interrogation. And normalization never asked, "Does this make sense?" Inside the Tokyo Stock Exchange, the matching engine, its heartbeat, operated blindly on protocol. Trade orders piled in, matched, cleared. It followed sequence, not sanity. Rules said auto-cancel on outage, not auto-flag on fat finger. So when 610,000 shares showed up at 1 yen, it whispered, "Execute." It had no context. It wasn't built for context. Regulators had layered fixes since Black Monday '87, since Asian Crisis '97. Circuit breakers added, trading halts refined. But fat fingers weren't considered existential risks. They were human errors, management's responsibility. No regulator mandated real-time sanity filters. They focused on spoofing, on algorithmic disruptions, on designated market makers. But this was a typo wrapped in entitlement, a systemic oversight hiding in plain sight. Across government desks, internal inquiries dug through logs. Engineers pointed at legacy frameworks, at third-party middleware, at systems built in eras before latency mattered. They argued that a fat finger filter would slow trading, cost Tokyo competitiveness. So it never arrived. So it never triggered. That evening, cups of sake passed hands of relief and of regret. Relief to have survived, regret for what they hadn't built in time. At Mizuho, the system mapping revealed no human in the loop, no validation screen for large orders, no cross-check flagging six-figure share segments at zero price. They had throttles for margin violations. They had safeguards for size limits, but nothing that demanded meaning, nothing that demanded sanity. The code trusted the keyboard more than the mind. In New York and Frankfurt, engineers watched too. They audited their own lines. They saw the same pipelines. They saw the same assumptions. They updated their filters. They added conditions. If volume greater than X times total shares, pause. If price less than market floor by Y%, flag. They built guardrails. But Tokyo still lagged, mothballed for speed. By dawn, pre-trade risk management became a mantra across Asia. Exchanges labeled legacy systems critical vulnerabilities. Regulators drafted rules demanding real-time filters on share-to-offering ratios, on unit price sanity, on order crossing. Trading platforms scrambled to integrate third-party guard modules. A new era of thoughtful automation began, slow, ironic, necessary. Yet beneath all procedural noise, one truth remained. This wasn't a glitch. It was an inevitability. A system built on assumptions, untested when speed eclipsed sense. A design born of ambition, unchecked by foresight. And as Tokyo's exchange prepared its next iteration, upgrading engines, rewriting code, the real question echoed. Would any of these systems ever ask why, not just how fast? Or would the next collapse arrive in another blink, another typo, next time without a whistle? When the dust settled, a new game began, not on the trading floor, but in hushed offices and courtrooms. Mizuho and the Tokyo Stock Exchange faced inquiries from regulators, civil suits from shareholders, and pressure from a public hungry for accountability. The fight would be legal, financial, reputational, and orchestrated behind closed doors. Mizuho's legal team moved into triage mode. They drafted settlement proposals long before anyone asked. They courted sympathy by highlighting human error, painting the trader as a scapegoat, a victim of a system built to fail. They sought to limit exposure, both financial and symbolic. They pushed the narrative, billions lost, but no malicious intent. The exchange, meanwhile, chose a different route, recalibration over apology. They admitted system flaws, agreed to fund tech upgrades. No fines, just contracts. They argued speed-driven competition required trade-offs and committed to incremental system improvements. Their public messaging was calm, almost clinical. We have already begun reinforcements. In parallel, shareholders and firms filed lawsuits totaling in the billions of yen. They named Mizuho, the exchange, even tech vendors. The question for the courts: who held liability? Who compensated fully? Who paid only lip service? Each hearing added pressure. Each document leaked added scrutiny, and each day broke into headlines. Inside Tokyo's government offices, the Ministry of Finance assembled a review panel. They listened to technical deep dives, architectural post-mortems, and human testimony, including that of the junior analyst who raised the alarm. Legislators drafted new bills, tightening pre-trade risk standards. But lobbyists whispered behind their shoulders, "Don't stifle innovation. Don't scare investors." The line between security and competitiveness blurred, the system's fragility turning into leverage. Months passed. Settlements were struck. Mizuho paid roughly 10 to 13 billion yen in civil damages, less than half the loss. The exchange shouldered some costs, but no executive was removed. The junior analyst resigned quietly. Her name never made headlines. She moved on, cautious and wary, a ghost in a rebuilt machine. With legal dust trailing off, regulators introduced binding rules, pre-trade filters, order caps, human oversight on anomalous trades. The exchanges installed smart gates to flag unusual activity, yet the loopholes remain tempting. A single unchecked keystroke, a moment of stress, a market racing ahead of sanity, and history could repeat. Years later, the JCOM typo lives in risk management textbooks. It's a lesson spelled out in court transcripts, coded into system patches, whispered during compliance training. But beneath every one of those updates lies a reminder: systems can be rebuilt, laws can be rewritten, but the truth is fragile. In the end, the world walked away convinced. Improvements were made, balance restored, confidence regained. But anyone who watches the code, who traces the logs, who hears the keyboard click, knows the real legacy: how close the system came to collapsing on a single human error, and how little thank yous echo in the silence of rebuilds. It's easy to applaud the fixes. It's harder to live knowing that sometimes the system needs an unsung whistleblower and a sobering near miss to survive. And the next time a keystroke needs to be questioned, will anyone be watching? If this truth made you see the system differently, share it. And if you want more stories they never meant for you to hear, you know what to do.